Welcome to this new webinar titled Introduction to Japanese Candlesticks, brought to you by Forex Europe. Without further ado, let's dive in and explore this interesting technical analysis tool. The Japanese candlesticks represent the price action of a session. A session might be like the daily session, the 4-hour session, the 5-minute session, the 1-hour session. I'm sure you get the idea, right? So suppose that here is the first price of this session, the first incoming price. We call this price, the first price, the open price. And then at some point in time, the market will mark the highest price reached during this session, which we call, of course, the high price. This is the highest price during this session. Later on, the lowest price of this session will be marked, and we call this the low price. Of course, the last incoming price of the session is called the close price. Now, this price action may be represented with a Japanese candlestick, a wide candlestick, a hollow candlestick, a bullish candlestick. These are synonyms. Of course, you can color it any color you prefer, but these are the colors, these are the terms that we use in the bibliography. Now, the session starts here, the open price, and it closes higher at the close price. And that's why we say that this is a bullish candlestick, a positive candlestick. The sentiment of the market is positive. And at the highest point of this vertical line is the highest price of this session. And of course, here is the high price. And at the lowest point of this vertical line is the lowest price reached, the low price. Easy, right? Very good. So let's take a look at this Japanese candlestick that is filled. It has a color. It's purple in this case, but again, you can color it any color you prefer. Now, let's take a look at this one. The session opens here, the first incoming price of the specific session. It's right here, the open price. Then it marks the highest price of the session, the high price. And then at some point, it will mark the lowest price of this session that we call the low price, and the last incoming price of the session, the close price here. So now, as you can see, the market opens here and it closes lower. The sentiment is negative. It's a bearish candlestick, right? It's a black candlestick, as you might read in some books or on the internet. In this case, of course, is purple. Now, the highest tip of this line is the high price, the highest price reached during this session, and the lowest price reached here, the low price. As you can see, the Japanese candlesticks signal different information. For example, as we will find out in a while, the size of this body will give us some information about the strength of the signal, right? The shadows, long or short, again, will give us some additional information. Good. Now, let's explore in more detail the anatomy of the Japanese candlesticks. Good. So, as we mentioned so far, we have a wide or hollow or empty candlestick, meaning that it opened lower and it closed higher. In this case, of course, it opened higher and closed lower. That's why it's filled. It's bearish, right? In this case, it's purple, or we can color it black if you wish. Now, the high price is the same on both candlesticks, and the low price again is the same on both candlesticks. What changes is the open and the close price, of course. Now, the relation, the distance between the open and the close price, this rectangle is called the body or real body. We can use either term interchangeably, right? Now, the distance between the high and the low price, it's called the range of the day. But since we have different time frames nowadays, we can call it the range of the session, right? It makes more sense. In the old times, it used to be a daily time frame only. Nowadays, of course, we have a lot more time frames. Now, the vertical bars above the candlestick are called upper shadow or wick, and the lower vertical bars below the body of the candlestick is the lower shadow or wick. Pretty straightforward. We will be using the terms as we move on in this webinar. The first candlestick pattern that we're going to discuss, that we are going to learn, is the hammer. The hammer is found at the end of the downtrend, at the end of a clear decline, right? And it consists of a small body. The color of the body is that it doesn't matter. It might be either black or white, filled or empty, right? And it has a very small upper shadow. So the buying activity, it was very limited on the upper area of the candlestick. But there is a long lower shadow, and more specifically 2 to 3 times the size of the body. This is a bullish candlestick, and what it means actually, the price action is that this candlestick sometimes, often gaps below the previous body. So this body and the previous candlestick's body do not touch. It might happen, of course, in the stock market. In the foreign exchange is not that usual. Very good. Now, the market opens here in this small body, and then perhaps it marks a small upper shadow, but eventually falls lower, much lower, but something happens there, and the market rejects these low prices, and then the market moves higher to close the session near the price where it opened. And this is the logic behind the hammer. Now, the hammer is a bullish candlestick pattern. It's a one candlestick pattern, but we cannot take it in isolation. We have to take it in conjunction with other technical tools. For example, one tool to filter out the good from the bad hammers, let's put it this way, is the presence of a support area near the low price. Another filtering might be that your favorite oscillator, let's say the relative strength index, is in oversold territory, right? And then another tool that might help us in this case is volume. If volume is available for this specific financial instrument that we are analyzing, then we would love to see high volume on this candlestick, increased volume, meaning that there is a lot of substantial buying interest activity. Now, the confirmation is always with price. If the next candlestick breaks above the high price of the hammer, then it's a confirmation that potentially what will follow is going to be an upward movement. Before any reversal to the upside, Japanese candlesticks might go sideways for a while before they move upward. I hope this is clear. So we cannot take any Japanese candlestick pattern like the hammer or the ones that will follow in isolation. We always combine them with other technical tools. Excellent. And here is a real chart where we can identify a hammer here after a prolonged decline, and then we can see what happened after this hammer formation. What followed was an upward direction. The next Japanese candlestick that we're going to discuss, of course, is the long wide body. Long, hollow body, or any other color you prefer. Again, I have to stress that many times. It's a hollow candlestick. But what matters here, it's a long wide body. And it has very tiny, very small upper and lower shadows. So there is no much activity above or below the body. Again, this is a bullish signal. And as I mentioned a few seconds ago, we need to combine it with other tools for filtering, like support, like oversold oscillator, like high volume. Yes, this is an extra tool. Volume is a very important tool. We need to see high volume on this candlestick. And of course, the confirmation will come with price, with another candlestick surpassing the high price of this candlestick. And on our price chart, we can spot here a long green. In this case, you see the colors differ. A long green, a long bullish body, right? Signifying that there is some bullish activity going on after a decline. And the next candlestick, of course, surpassed the high price of this long green body in this case, and this is a confirmation of the upward movement. Again, nothing is 100% when trading the markets, when analyzing the markets, and we always have to take to follow risk management rules. Another interesting Japanese candlestick pattern, this one is called the Bullish Engulfing. Again, a prerequisite is a downtrend, a clear decline, and then a short black body, ideally is short, confirms the downward direction, right? It's a downtrend, and then we identify a black filled, a bearish candlestick. Then a long wide body is formed, and this long wide body contains the previous body. So you see, this body is within this body of the long candlestick. This is called a bullish engulfing, and again we have to practice some filtering, like oversold oscillators, like support in this area, high volume if volume is available on this financial instrument that we are analyzing, and confirmation will come with the next price when exceeds, when surpasses the high price of the bullish engulfing pattern. And let's identify the bullish engulfing on our price chart. And here we are. You see, this is a downtrend, a small bearish, right? A red one, a small bearish candlestick following the prevailing trend, and then a long bullish, in this case is green, candlestick where the small body is contained within the long body, right? What happens next, of course, is history. It was an upward movement, no doubt about that. And the last bullish candlestick that we're going to discuss, the last bullish candlestick pattern that is of course the morning star. Again, the first prerequisite is a downtrend, and a long black body is formed that complies, if you wish, with the downward movement. It's in the same direction. But a small candlestick gaps lower below the previous body. The two bodies do not touch. This is what gaps down or lower mean. And the third candlestick, because this is a 3 candlestick pattern, it's a long bullish body, right, that surpasses the 50% of the long black body. So these are the prerequisites, and again, it would be nice to have a support area here right below the morning star. It would be nice to have oversold oscillator or oscillators, and high volume would be always helpful on this pattern. And again, the confirmation comes with the next candlestick surpassing the high price of this long white body. Let's identify the morning star on our price chart. And of course, it's not hard to do that. Here we are, the long bearish body, a small body that gaps lower, and then a long bullish body signifying the upward sentiment that is going to happen. Now that we covered the bullish candlestick patterns, it's time to explore the bearish ones. One of the popular ones is the shooting star. The shooting star is identified at the top of the uptrend. It has a small body of either color and a small or non-existent lower shadow. It has a long upper shadow, 2 to 3 times the size of the body. Now, again, the shooting star should not be taken in isolation, but instead in conjunction, in combination with other tools, like an overbought oscillator in this case, a resistance near the upper shadow, high volume, high activity, high selling pressure, if you wish. And of course, the confirmation will come with price when the price will fall below the low price of the shooting star. The shooting star on its own does not guarantee a bearish reversal. And I have to repeat that many times because this applies to all patterns. Excellent. So let's move to the next one. Here we can identify the shooting star on a real price chart at the top of the uptrend, right? Small body, either color in this case is green, is bullish, and a small lower shadow, a long upper shadow compared to the lower shadow, of course, and the rest is history, right? What happened next is the long bearish candle fell below the low price of the shooting star, and what followed was a bearish reversal indeed. Now, a long black body now will indicate that the uptrend has come to an end, potentially, and there is a lot of selling activity. Ideally, a ideally an overbought oscillator would be a nice filtering tool, and of course a resistance near this area would be helpful. High volume again, indicating the seller's activity, right? A lot of selling pressure, so this long bearish candlestick will form. It opened here and it closed here. This is what a bearish candlestick is about. And again, what might follow is a sideways market, like all candlestick patterns that we're discussing here, and then a candlestick that will fall below the low price of this long black body will signify the beginning of a downward movement. On our price chart, on a real price chart, we can spot right away this long bearish candlestick will signify the beginning of a downward movement. Next bearish candlestick pattern is a two candlestick pattern. It's the bearish engulfing pattern. So in this case, the prerequisite is an uptrend and a small white body signifies the buyer's commitment to pull the market higher. But then a long black body, for some reason that we do not know, is formed, and this long bearish body contains the previous body, meaning the open and close price of the previous candlestick is within the body of the long bearish candlestick. Again, filtering might be overbought oscillators, resistance near this area. A sideways market might follow before the market will fall below the low price of the long bearish candlestick. And of course, price will confirm the downward movement when the candlestick will fall below the low price of this pattern. And on our price chart, a bullish engulfing, a bearish engulfing pattern, that is, a bearish engulfing pattern, we can see right away here, right? An upward movement, and this long bearish body contains the body of the previous candlestick. We have to note here that this body is not small, but in the previous explanation I said ideally small. It doesn't have to be small, right? Good. So we're moving forward with another bearish candlestick pattern. Now this is a three candlestick pattern, is the evening star, and again a prerequisite is an uptrend followed by a long white body that complies with the upward movement, right? And then a small body that gaps up. The small body usually indicates indecision, right? And indeed, after this small body, what follows is a black long body, a bearish long body that falls below the 50% level of this long white, long bullish candlestick. Then when price falls below the low price of the long black candlestick, then this will confirm the downward direction. Again, before any downward direction, we might experience a sideways market for few candlesticks before prices fall lower. And on a real chart, we can identify a bearish candlestick right here at the top of the uptrend, a long green, in this case, bullish candlestick that follows the upward movement, a small body indicating indecision, and then what follows is a long bearish candlestick that falls below the 50% of the green candlestick in this case, and then the next candlestick confirms the downward movement, the reversal, because this candlestick fell below the low price of this pattern. Good. So this is what I had for you today, guys. I hope you enjoyed it. Want to understand markets and technical analysis better? Follow iForex Europe for more quick and easy guides to trading. Stay tuned for more.